We are going to give you our swing trading hedged grid system in the next few minutes. Pay attention because this is real life and not theory. Trading Forex is risky. We actually don't teach, basically we do, and the unhedged version of this strategy traded millions of dollars for 7 years. We think this version is even better. The truth will be in the numbers, and we have various links in the description about how you can join us, including the independently audited MyFX book statistics and our free Telegram group. Stick around to the end, and we might just open your eyes.
The strategy is a manual grid strategy, and it follows our skeptical thinking, so that we want to buy when markets get too emotionally downbeat about a currency pair, and we want to sell into optimism about a currency pair. This is counterintuitive and goes against any trading course we've seen which tells us to go with the trend. While it has traded exotic and emerging market pairs profitably in the past, it only trades major and minor Forex pairs now to reduce the cost of swaps and the inherent political, geographic, and economic uncertainty around many exotic or EM pairs. When markets are overbought or close to overbought, we open trades counter-trend. When profit targets are hit, trades are closed. If the market continues to move against the initial position, then a second trade is opened based on candlestick price action and how the market is trading, pending news, etc. Up to 10 positions may be opened for each of 2 pairs, so worst case scenario 20 trades. Though this has never happened, the account is modeled to cope with this. Conversely, when markets are oversold or close to oversold, trades are also opened counter-trend. When profit targets are hit, trades are closed. If the market continues to move against the initial position, then a second trade is opened based on candlestick price action and how the market is trading, also pending news, etc. Once again, up to 10 positions may be opened. Risk control is achieved by the following. 1. We trade just 2 Forex pairs at any one time. 2. Our swing trading timeframe. 3. Position sizing. And 4. Hedging. Finally, and number 5, there is a hard stop if both currency pairs end up fully hedged at the same time. Position sizing and hedging are the most important feature of the strategy. Our copy traders will often happily accept extraordinary profits and only query the strategy when they experience a stressful drawdown in their own account, even while the master account remains quite safe. This is because they have failed to understand how crucial position sizing is for the strategy. Directly managed clients don't need to worry about this, as we manage the position size along with everything else. Indeed, when you have listened to the video, I suggest you listen again to this part one more time because it is the most important.
Here is a practical example behind me because we actually sold $yen this morning at 147.76. Starting on a weekly time frame, we notice that it has risen 3 weeks in a row, and looking left on the graph, this pair is now beginning to meet an area that was significant resistance in the past in the 150s. Dropping down now to a daily time frame, we can see that on the bottom of the graph, and using RSI, that this market is approaching overbought territory. We execute a sell order on this daily time frame. We are not hugely concerned with each individual pip because, to use an analogy, we are looking at $yen from 50,000 feet and certainly not trading it on the 1-hour time frame as most grid traders do. As this is Thursday, we see in our calendar that United States initial jobless claims will be released at 8:30 a.m. in New York, so this period will be a little volatile for the dollar, and we may make money on this today. We know one thing for sure: it will either go up or go down. It has no choice. Our position size is going to be 0.01 lots for every $1,700 of capital under management, and we are ready for whatever happens. Our first position size is going to risk 0.3% of the account, or 80 pips. If $yen goes into drawdown by 80 pips, we now have the option to add to our grid. Since profits obviously take care of themselves, we will likely close the trade for an 80 pip profit, though we reserve the option to add to our winner. However, profits are the easy bit. We don't yet know what dollar-yen will do at 8:30, but let's assume we are wrong. What happens next?
As we just said, the first position will risk 80 pips before we get a green light to begin our grid. Because we trade manually, getting a green light does not actually mean we must sell again. If there is a strong move higher, we can simply stand aside and let it settle down and then sell again. However, for simplicity, let's just open a grid here and let's space every position 80 pips apart. In reality, the spacing won't be exactly 80 pips for each position. As you can see, we open a second, a third, and a fourth position. Most times, this will be enough to turn a losing trade into a winner. However, let's once again assume it is still not working and dollar-yen continues to move higher. Notice now on position 5 we add a small hedge using the same position size as the other 4 sell positions. We have bought dollar-yen and are 20% hedged. We do the same at position 7, making us 28% hedged. By the time we get to position 10, we have 10 sells and 2 buys and are 20% hedged again. This hedge could be compared to the handbrake of a car. We are slowing the deterioration of our position. Over time, one of two things can happen.
Let's say 10 positions does the job and our overall drawdown reached 16% before we eventually got the reversal off deeply overbought conditions that we were looking for. We can pay for the 2 hedges using profit from the 10 sell positions, or indeed, we may even be able to close one of the 2 hedges as the market reverses and begins to trade lower again. This means we get out sooner at break-even or perhaps for a small profit. Of course, the other alternative is that the market continues to move higher, increasing our drawdown. With 10 sell positions, we will not add an 11th because it increases risk and does not improve the average entry very much. As the position continues to deteriorate, we now hedge the remaining 80% of the trade at a 25% overall drawdown. We know that markets oscillate like wave patterns and that in time this wave will reverse too. It always does. It's why we called the company Blackwave. In the meantime, our account is protected, being fully hedged on dollar-yen. We can still trade one other pair, and we will have ensured that this other pair is not hugely correlated to dollar-yen. This other pair trading in and out will continue to improve the cash position and move the account forward. Sort of like a plane now flying on one engine, it is still moving forward.
Eventually, dollar-yen does indeed reverse and trade lower. We now have the opportunity to close our hedge at break-even. This means our trade is alive again with 10 sell positions and 2 hedges. As the reversal continues over time, the 10 sell orders will pay for the 2 buy orders, or once again, we may be able to close at least one of those hedges at break-even. In the unlikely event that both Forex pairs become fully hedged at the same time, we will close one of the pairs fully for a 25% loss to the account. This once again leaves us free to begin flying on one engine again and moving profits forward while we deal with the other fully hedged position. As we expect average growth to be 5% per month, the loss would be eaten quickly. When all trades close, we are back to 100% cash to make withdrawals if needed. We are also free to begin flying again on 2 engines.
As we said in the beginning, we don't teach, we do. Sometimes I think teaching would be easier. If we just taught trading, it would be risk-free. We could charge you then, tell you what to do, and pick holes in your decisions if it didn't work out, and accept the praise when you made money. Sound familiar? No, we have our own skin in the game. If we think it works, then why wouldn't we do it ourselves? This is not a video about some magic beans piece of technical analysis either. It is a sober video about risk control because trading Forex is risky. We know this and you should too. Check out the links in the description. The MyFX book links will provide audited returns from an independent source. The links are available too if you want to copy our trades. Blackwave California is our low-risk account, which has already been trading for 8 years. Alternatively, we can manage your money directly at Blackwell Global for a 25% performance fee, which means if we make you money, you keep your investment and 75% of the profits. No performance equals no fee. Finally, you can try this yourself. We will continue to upload videos about our strategy for people who don't actually teach trading. We will try our best to explain what we do. Subscribe if you want, or fucking don't either. Our goal is not ad revenue from YouTube, but trading profits. As we are tunnel vision on this cash machine, we like to talk about it, so there will be lots more videos, perhaps 2 videos per week. Thank you for listening to the end. I wish you all the trading profits in the world.